Howdy, folks. I hope this finds you well. In this week's edition of Planning for High Earners, we're going to talk about planning and market volatility. So let's talk about a couple of normal things. It's 100% normal for you to have anxiety and to be concerned when there's market volatility. And let's be clear about what else is normal. Market volatility is normal. Let's look at the last 30 days. And we're just talking about the U.S. stock market, but there's volatility all around the world all the time. And the bond market this year with rising rates has been the most volatile market. But in any case, let's look at the last month of the S&P 500. Started the month heading pretty much straight down. About halfway through the last 30 days, it was down about 5.9% from the beginning of October. Since then, it's recovered, and as of earlier today, it was up about 0.2% over the last 30 days. That's normal. The other thing that's normal is in any given year, and that's every year, we have a peak to trough to peak market of about 14%. That is, if we started at 100, it goes down to about 86 and comes back to 100. And that's average market over the last 100 years or so. It happens essentially every year on average. So all that volatility is normal. And your anxiety about your money, and especially your invested dollars in market volatility, is also normal. So when you put that together, it can cause you to start questioning your plan. Well, a properly done plan uses something called Monte Carlo analysis. And what that does is it runs at least 1,000 trials, but sometimes many thousands of trials of different sequences of market returns and different levels of volatility over time. And then it runs the analytics and gives you a success metric that is, let's say, your plan is successful under 80% of these trials. So in a properly done plan, volatility is actually baked into the plan. And very simply, the best thing you can do is save your way through volatility and ignore it. And in addition, have enough of an income or cash reserve so that if you need cash, you don't have to dip into your investments while the markets are down. Because actually taking money out incurs a loss. If you leave your money in and let it ride, what you have done is experience a temporary reduction in value. So, from a financial planning perspective, a proper plan incorporates volatility, expects volatility, and then you yourself as the consumer of that plan or the implementer of that plan, you don't have to be comfortable with volatility, but you should have a plan for it because it's going to occur. And the worst thing you can do in times of volatility is actually take your money out of the market or stop saving, or both. I hope you find this useful. Please let us know if there's any particular topic you want to cover, and we'll see you next time. Bye-bye.